Netflix just bought back $4.7 billion of its own stock. That's the biggest single quarter of share buybacks in the company's entire history. That's really amazing, and it happened in the exact same 3 months that Netflix revenue growth slowed for the fourth quarter in a row. One of those facts sounds like confidence, and the other sounds like a warning. Today, they are the same story, and the gap between them is the most interesting thing in this report. I'm Vikas, your host. This is what changed from VYNG. We don't chase headlines, we explain what changed. Three lines. Number one, the headlines: Netflix delivered a clean quarter, revenue right in line with expectation, an operating margin that beat its own guidance, and earning a penny ahead. But the reality is, the stock walked into the clean quarter already down about 44% from its high because the market has stopped paying for the results and started asking a harder questions. Now, the number said on track, the share price said, prove to me what grows next. Both can be right, and this quarter they were. Let's start with what actually happened. Because of the surface, not much went wrong. Revenue came in at $12.56 billion. That's growth of about 13.5% over last year. And it landed almost exactly where Wall Street expected. Operating margin was 33.4%, which is actually better than the 32.6% Netflix had guided to. And earnings per share were 80 cents, a penny ahead of the estimate. If you stopped reading right there, you would call it a good quarter, and you would not be wrong. But here is where you have to read past the headline. Look at the pace of growth, not just the level. A year and a half ago, Netflix was growing revenue at about 17.5%, then 16, now 13.5. And the company's own guidance for next quarter is around 11.5. That's four quarter in a row of the growth rate stepping down. It's not falling off a cliff, but it's unmistakably decelerating. And the reason matters. For the last 2 years, Netflix growth had two big engines that don't repeat: cracking down on password sharing and raising prices. Those were one time boosts. They worked beautifully. But you can only stop password sharing once. You can only raise the price so far. So the question the whole market is now asking is very simple. What's the next engine? Here is my one analogy for the whole episode, and I will keep coming back to it. Think of Netflix like a fantastic restaurant that just raised its prices and customers paid because the food is that good. Revenue jumped, but you can't raise prices every single year forever. At some point, the owner has to invent a genuinely new reason for people to come in. Maybe a new menu, a bar, or live music. That's exactly where Netflix is standing right now. The price hike worked, the bills been paid, and now everyone's watching to see what's the new reason to visit it's going to be. Now, the second thing that changed, and this one is sneaky because it's about the cash, not the profit. Netflix free cash flow, that's the actual cash the business generates after it pays for everything, that fell to $1.5 billion this quarter. That's down about 33% from a year ago. And that looks alarming until you understand why. Remember last quarter? Netflix walked away from buying Warner Brothers and collected a $2.8 billion breakup fee. That fee made last quarter's numbers look enormous. Well, this quarter, the tax bill on that fee came due. So the same one event flattered the spring and then drained the summer. If you zoom out to the whole first half of the year, cash flow is actually up. The 2 quarters net out. It's a great example of why you never judge Netflix on a single quarter's cash number. You have to net the noise. So, revenue fine but slowing, margin ahead, sorry, cash distorted by one off. That's the what changed. Now, here is why it matters. The most revealing thing in this entire report is not a number, the number Netflix put in the headline. It's the number they are taking away. Buried on page 5, Netflix announced that its viewing hours report, the big engagement disclosure, is moving from twice a year to just once a year, starting in 2027. The reason they give is reasonable sounding. They want investor to focus on revenue and profit. But notice the pattern. Netflix already stopped telling us its subscriber count back in 2025. And now the engagement numbers are getting thinner too. Here is the behavioral trap, and it's the one flag I want you to walk away with. You can't miss a number you no longer see. As the volume grows, slows down, the volume disclosure are quietly disappearing. I'm not saying that's sinister. Focusing on profit is a legitimate choice for a maturing company. But you should notice when it's happening. The metrics that would confirm or deny a slowdown are exactly the ones being retired. Right as the slowdown shows up in the revenue line. Absence of metrics is not evidence of strength. Now, the flip side, and this is what keeps me constructive rather than negative. Watch what management is doing with its money because that tells you more than what they are saying. Netflix bought $4.7 billion of stock in a buyback this quarter, the record I opened with. And back in April, the board authorized an extra $25 billion of buybacks right as the stock was falling. Think about what that means. The people who know this business best are looking at a stock that's down 44%, trading at under 25 times earnings when it used to trade above 40, and they are buying it as fast as they responsibly can. That is not the behavior of a management team that thinks the story is broken. That's a team that thinks the market is wrong. And they might be, because underneath the declaration, the next engine are being built. You just can't see them at full size yet. The advertising business is on track to roughly double to about $3 billion this year. Live events are driving some of Netflix's biggest sign up days ever. The kids' game app tripled its daily player since spring. None of this is big enough to replace the fading price hike tailwind today. But that word yet is the entire investment debate in one syllable. So the tension is real and it's honest. A genuinely excellent business growing more slowly, being repriced by a nervous market, while its own management bets heavily that the fear is overdone. Right. Last quarter, on the evidence at the time, this name set an implied 6.5 out of 10. Today it moves up to 6.8 out of 10. And I want to be clear about why it went up in a quarter where growth slowed, because that seems backwards. It went up because two things improved: the margin beat its own guide, and the full year profit target held, which means the profitability story is intact, even as the growth story cools. And the stock got cheaper, which for a business this strong improves the risk and reward, not worsen it. The declaration is real, and it's why this is not an 8, but world class operator buying its own stock at a 2-year low valuation with a 20% plus profit growth here in front of it earns a step up in the confidence, not down. Now, the disclaimer: this is not a buy or sell recommendation. It is just our assessment of how much confidence today's evidence deserves. Three questions the next quarter will answer. Does the revenue growth stabilize or keep grinding lower? Next quarter is the first full quarter of the recent US price increase. So we will find out if 10% in the home market is the floor or a stop on the way down. Number two, does the advertising business actually close its big commitments and prove it can be the next engine? That's the single clearest proof point on the table. And number three, does the record buyback pace continue? There is $27 billion of firepower left. If they keep spending it this fast, that tells you management still thinks the stock is a bargain. Here is the real story, not the headline. Netflix didn't have a bad quarter, it had a fine one and got repriced anyway because the market wants to see the next growth engine before it pays up again. The information was not in the revenue line everyone forecast. It was in the cash, the disappearing metrics, and the biggest buyback in company history. If you would like to explore every source and calculation behind today's analysis, you will find the complete research report at vyng.io, vyng.io. Everything is sourced directly from Netflix filing because trust is not built by confidence, it's built by transparency. I am Vikas. This has been What Changed from Wing. We don't report everything, we report what changed. Clarity, not clutter.